afternoon and welcome to this joint webinar hosted by Bracewell, BDO and Evercore. By way of brief introduction, I'm Chris Williams, Managing Partner of the Dubai office of the international law firm Bracewell, and it is a pleasure to have so many of you join us. I'm delighted to be joined on today's webinar by my colleague Oliver Phillips, who has particular expertise in advising clients on all manner of M&A related matters, and by our friends at BDO. Sharjeel Abdur, Head of Advisory in Saudi Arabia, and Shivendra Jha, Head of Advisory and Business Service Outsourcing in the UAE. Last but by no means least, I also have pleasure in being joined by Hugo Baker, who is a Director in the Dubai office of Evercore, one of the world's leading investment banking advisory firms. These are quite incredible times that we live in, even for those of us who worked through the financial crisis of 2008 and have memory of other significant economic or political events that have shaped the world that we live in. As we start to hopefully see light at the end of the tunnel, or at least a move towards some degree of normality, we also see opportunity, not least in the M&A market. It is the exploration of these opportunities and readying for the same that form the basis for today's webinar and our earlier thought leadership piece on the same. I do hope that you'll find today's presentation both interesting and thought-provoking, and with this in mind, we have attempted to make the same as interactive as possible, so no snoozing off, please. With that, over to Sharjeel, who will be moderating the panel discussion. Sharjeel.
Thanks, Chris, and everyone, good afternoon. Welcome to this webinar where we will be spending next 50 minutes to an hour approximately in discussing how the situation has unfolded, the opportunities, threats, challenges in the M&A market. Briefly introduced by Chris, myself, I'm Abdur Sharjeel. I am Head of Advisory with BDO Al-Amri in Saudi Arabia, working on several transactions, helping on buy side and sell side. If we briefly look at M&A activity in the region, particularly in KSA and UAE, 2019 was really a great year. Some significant transactions happened, and we all were expecting that 2020 would be a great year, and there were already some very interesting transactions in pipeline when the year started. However, the situation is not the same anymore. Unfortunately, we all know this pandemic happened, and now we are living in some unprecedented times. This pandemic has shaken the global economies. Businesses are struggling. Businesses are looking to either scale down their operations, or some businesses have actually completely shut down for a while. So it is really, businesses are living in an environment where survival is a priority, not to talk about expansion and growth. So with this, this change has undoubtedly impacted all aspects of business, and M&A, of course, is not an exception. So with this in background, we thought this is the right time to discuss what the buyers and sellers of businesses should expect in foreseeable future. What changes has taken place in the market, what challenges they might face coming up, and finding the buyers, closing the transactions, financing the transactions, so on and so forth. So in order to discuss this, we have come up with highly relevant panel of speakers here. Chris has already introduced my panelists, but I will take an opportunity to briefly introduce them again. We have Shivendra Jha. Shivendra is a partner with BDO in UAE. He's based in Dubai, and he heads the advisory function at BDO. And he is involved with several buy and sell side transactions when it comes to M&A. Oliver Phillips is corporate lawyer with Bracewell Law, and he is also based in Dubai. He has significant experience of corporate deals on both buy side and sell side, advising his clients and enhancing the value of the transactions. My third panelist is Hugo Baker. He is director at Evercore and based continually between London and Dubai. He has significant experience in investment banking and again advised several clients on the acquisitions and sale transactions. Before we move on to the real talk, a few logistics here. First of all, we will be asking some poll questions. We want to keep you engaged. We really want to make this webinar very relevant to you, what you want to hear, and you definitely have control on the direction to some extent by participating in those poll questions. I would really appreciate if you can participate in that. We will keep poll questions open for 30 seconds, and we will share the results, and then we will try to build up our discussion based on the result of the poll questions. Secondly, if you want to ask questions, there is a chat panel on the right side. If you see, you can type your question, and you can type the name of the panelist you want to ask the question. And at the end, we will have question and answer sessions. I will compile all those questions, and at the end, I will ask the relevant panelists to respond to those. With this brief introduction and logistics, let's start our real talk. So maybe, Oliver, I will start with you. We know what has happened. The pandemic has affected everything. The economies have been impacted ups and downs. So maybe you can provide us an overview based on the current economic environment in the Middle East. What do you think is going to unfold, how the deal business is going to unfold, and how it has been impacted so far by this pandemic?
Yeah, sure. So I think in economic terms, as you say, the Middle East currently is, and as the rest of the world, is barely recognizable compared to that which we saw entering 2020. 2019 was a real bumper year, but the crash of oil prices and COVID-19 have badly hit the Gulf. We've seen tourism almost flatline in Dubai, and the crash of oil prices has hit Abu Dhabi, Saudi, and other oil-dependent economies in a significant way. And we've seen this really play out. We've seen in Dubai hotels literally sitting empty. Some are already closed, some are already for sale. Reportedly, almost half the restaurants and hotels surveyed by the Dubai Chamber of Commerce expected to go out of business in the next month alone. 3/4 of tourism companies also expecting to go out of business in the same time. The airports here have looked like novelty parking garages for just aeroplanes whilst the country was thrown into lockdown. And from a project and infrastructure perspective, we've seen in the first 6 months of the year a 19% decrease in new contract awards in the GCC compared to the same period last year. This has led to the mass repatriation of blue-collar workers who typically work in the construction sector, and we've seen over 200,000 blue-collar workers request to go back to India alone. And this picture is broadly the same across the entire region. Forecasts for oil prices are around $35 to $45 per barrel, which is significantly below the $60 price we saw at the start of the year. And in particular for Saudi, this represents a huge shortfall in their fiscal break-even price. Just generally looking at the global economy, the IMF is predicting a shrinkage of about 4.9% for 2020. But more positively, and thinking about as we emerge from this crisis, we are starting to see what I dare call some green shoots appearing, some positivity. Tourism is looking to reopen in the UAE. COVID rates, looking at recent data, do look to be on the decline, although there have been some recent spikes, and we'll have to watch these depending on how that's affected by tourism as it reopens. Local airlines have tried to globally lead the way in recommencing flight networks. And whilst the oil price is lower, at least the oil price is stable since the OPEC group agreed further cuts in production. Potentially positively is the fact that Dubai has pushed back the Expo for 2021. And this does allow the city to retain some form of stickiness for businesses and employees in the region who want to stick around to see what actually transpires with the expo. So whilst we're far from being out of the woods, and the economic damage caused so far is no doubt going to take years to repair, we are seeing currently already some early positive signs. And so we'll talk about deal levels later, but broadly speaking, the effect on the M&A in the Middle East has largely been that it's the same that my friends and colleagues across the world are seeing, and that is, as a generalization, activity largely to standstill. The reason for this isn't the strength of the economy. In my experience, whether the economy is strong or weak, deals are getting done. But the ingredient which always kills deal is uncertainty. And unfortunately, the prevailing theme of 2020 so far, and of the COVID crisis in particular, is that element of uncertainty. We saw the same in the financial crash, when uncertainty in the financial markets paralyzed deal activity and made it impossible to agree a price because the economic forecast was so uncertain. And so, as you said in your introduction, most players have now retreated from the M&A battleground, and they are trying to focus on their own businesses, whether it's their own operational businesses or portfolio companies. But I think this is a temporary retreat, and they are looking at the drawing boards, and they are looking at strategy, and they are looking, as soon as there's economic certainty, to look forward to get back into the battleground.
Okay, thanks, Oliver, for this overview. One follow-up question on that. Do you think in Saudi Arabia, in this market, Vision 2030, has been implemented, and government spending was planned? Of course, there would be certain cutbacks on the projects would be delayed, etc., and so on and so forth. So how you see Vision 2030 being impacted? Would that create some additional sectors and some additional opportunities in the market, or would this pandemic result in delaying that vision implementation?
I think, in my view, the 2030 vision will definitely lead to and drive economic stimulation. Certainly within construction, within tech, within tourism, and the reforms we're seeing socially and politically within Saudi will also work in tandem with that vision plan to try and create further economic stability. However, that doesn't take away from the fundamental economics of the region. It doesn't take away from the fundamental economics of the country at running at a deficit, being far from its fiscal break-even price. So whilst there will be activity, and we all know that in the region, a lot of M&A deals are actually, I think in over 50% of deals last year, the government had a role in either buy side or sell side. But as I say, the fundamental, economic metrics don't change, just regardless of whatever vision is in place. And 10 years away is 10 years away. That's largely in a lot of people's mind is a whole economic cycle away.
Okay, thank you. So Hugo and Shiv, do you want to add something to this talk?
I mean, I think all of us has made a series of very good observations. I think he's absolutely right. And on your latter point, I agree. I think, if anything, the sort of current environment will almost be a bit of a reset to really pursue and reinvigorate some of these 2030 objectives from a different base and to really develop going forward.
Okay, Shiv?
One point on that, we see that this is within such a short period of time. If you look at that, governments across the world have been forced to take steps into uncharted territories of corporate support. So as we speak, UAE announced yesterday a new economic stimulus package of work, I think around 1.5 billion AD, which increases the total stimulus package to 6.3 billion. I think this is also, if you look at it's a phenomenal, though we see that these government support for business will have an immediate benefit. But as we come out of the current situation, I think the strain on working capital and the need to recapitalize balance sheet may become more acute as we move forward. So I think what Oliver mentioned is like, the 2020, what we see is definitely full of challenges and lots of opportunity as we move forward, because it's all about the uncertainty, how the information will be processed, how the stimulus package will be utilized in a, like, the practical terms, spread across the business. Though in the metaphoric terms, we see that, okay, those are the announcements, but how effectively it is like, helping the business to get that support in real terms is worth looking at.
Okay, so all very valid points and very interesting. So let's see what our participants think and what is, we'll try to feel the pulse by letting them participate in a poll question. So Shirley, maybe if we can load our first polling question here.
Sure, sir.
So I would really encourage all the participants to participate and give us your view, what you think, because we want to build on our discussion based on the results of these. So what is your overall market sentiment regarding M&A activity in 2020 as compared with 2019 in terms of volume? Do you think it will increase? Do you think it will decrease? It will remain the same? Or at this point, you cannot make an assessment? So we'll keep it open for 30 seconds, and then we will see what our audience view is.
Okay, 62% have voted. Should we wait some more?
Maybe wait for 5 more seconds and then close and show us the results, please.
Sure.
Okay.
Okay, shall we?
Yep, sure. Wow, we have a great audience, which is very optimistic, and that's really a good sign. So 33% of participants think it will increase, 48% believe it's going to decrease, 4% it will remain same, and 15% cannot make any assessment at this point. That is really interesting, and I'm happy to see 33%, such a big number on the increase side. So maybe we will build up our discussion from here, and I will go to Hugo. I will ask you to maybe talk us through what was the M&A activity level in first half of 2020, and what do you think would be the expected volume in the rest of 2020 and maybe Q1 2021?
Sure, I agree. It's certainly an interesting poll result, and glad to see there are some optimists out there. I think the first half of the year was undoubtedly a tough start, shall we say, and there were approximately, depending on what source you look at, about half the number of deals versus the last few years. So M&A has been down year to date, but it's not out. I mean, there have still been a lot of deals happening. Most of the deals that have happened have been deals that were either well progressed before the lockdown, before COVID became a real issue, and particularly where diligence had already been largely completed, or where companies had to transact for sort of stability or liquidity needs. So M&A is still there, and there still are parties on both sides, but the speed and severity of the downturn has created a vast chasm, you might say, between buyer and seller expectations. A lot of the sellers still have in mind, and indeed were marketing based off 2019 performance, which was pre-COVID, and a lot of the buyers are trying to protect themselves and look at sort of forward or 2020 figures, which clearly are very negative, and the sellers don't want to be to transact at those sorts of levels. So what we saw particularly in March and April was a significant number of transactions or processes that were paused. There weren't many cancelled straight away just because of the speed of the crisis sort of development. But I think actually what's really positive is over the last month, 2 months or so, we've seen some of these processes get back underway in slightly different guises. There have obviously been a number cancelled, particularly those with sort of businesses or underlying businesses that have been particularly affected by COVID. But we are now seeing, as I say, a sort of people beginning to come back to the market. A lot of teams, both sellers and buyers, were focused for the last few months on the internal self-help, getting their own ship righted and making sure they're able to cope and survive the COVID environment. And now there seems to be a bit of light. Lockdowns are reducing. People are thinking a bit more about the future and have a little bit more confidence and willingness and time, frankly, to actually think about M&A. But I think going forward, M&A is going to be quite different to what it was pre-COVID in terms of how a process is run and indeed how a transaction ultimately comes together. From the process side of things, I think formal processes for the time being are largely dead, with the very few exceptions for very high quality and very much sought after assets. I think what we're seeing now is much more flexibility. People don't like being held to deadlines. Buyers are not willing to sign up to short-term deadlines, to indicative bids. It's much more about collaborative discussions without the pressure of a bid deadline to work out how can you get to a deal that's beneficial for both parties. And so processes are less structured, and by default they don't have the same necessarily accelerated timelines in large part. I think the other area I'd highlight is that sort of buyers and investor pools are probably smaller, but they come from a wider base. So it's a lot harder to predict, particularly for international buyers investing in the Middle East, exactly which buyers might turn up and be serious. There's a lot of people tire kicking, but there are serious buyers out there. But whereas before you might be able to pick, the 5 strategic buyers you would go to and would be the logical owners of a business, that today is harder because those strategic buyers may also be struggling and they don't have the capital. I think on valuation and structure, because of this big bid-ask spread, what we're seeing is much more innovative and complex structures that manage some of the risk for buyers but provide some of the sellers with upside. So that's earnouts, contingent payments, and other forms of structuring that help share the risk going forward. And then the consequence of all of these is that transaction timings are just taking longer. You have both challenges in terms of diligence, and that may ease a bit as travel restrictions reduce, but it's not going to be straightforward in the near term, particularly for businesses obviously that have hard assets. But also the time taken to get through negotiations is a lot harder given the more complex transaction structures, but also some of the concerns that buyers are sort of beefing up. And I think Oliver can speak to this in some more detail as well. But a lot of the warranties and the like that buyers are insisting on putting in transactions just takes a lot longer for both parties to get their heads around and to ultimately come to a sort of a landing on. So that's sort of how we're seeing the M&A environment develop, and I don't expect those sort of characteristics to change this year, but I I do believe that the second half is going to be a lot stronger than the first half of the year. Indeed, there were quite a few processes that were planned for H1 that are now in wait and see mode. And I think over the summer, people are evaluating what to do, and you could see several parties come to market in September, October.
Okay, that's very comprehensive. Thanks, Hugo. Maybe with this, let's see what our participants feel and think. Maybe, Shirley, if we can go to our polling question 2, if you can please display it on the screen. And let's see what our participants think. What is the expected volume of transactions in 2020 compared with 2019? So if the deal value-wise, not the number of transactions-wise, but value-wise, if the deals drop, what do you think would be the result? Would it mean it would remain same at 2019? Would it decrease 1 to 10%, 10 to 25%, 25 to 50%, and greater than 50%? I expect that 33% of my participants actually are expecting an increase. So probably this question might not be relevant for them. But let's see what the result is. Okay. So.
Should I stop the poll then?
Yeah, let's do it and let's share the results here.
Yeah.
Okay, so 48% of participants think that the deal volume is going to decrease by 10 to 25%. I mean, 48% of the participants who participated. And then 36% think that it is going to be between 25 to 50%. There could be a decreased deal value that we could see in 2020 compared with 2019. Maybe, Shiv, I will come to you and let's talk about, we all are saying that there is uncertainty in the environment. The pandemic has changed everything, but still, of course, this type of environment creates some opportunities, and there would still be transactions taking place in this environment. So let's talk about what type of transactions we are going to see, how this acquisition, merger and acquisition transactions, whether these would be growth-based transaction to fulfill the growth aspirations, or whether it would be distressed transactions because of liquidity or other issues. So what type of transactions we should anticipate seeing happening in the market?
Sure, Abdur. And I think, what we are seeing is definitely that uncertainty. But what if we look at this current COVID crisis and compare it with the 2008 financial crisis, given that serious health implication in addition to the financial consideration. 2008 recession, in 2008, if you look at post 2008 recession, M&A activity rebounded relatively quickly, through which we can offer some hope given the current situation, though it's not identical to 2000 yet, but it had some identifiable similarity. And if you look at the same way with the effects of the government in stimulus, how it happened in 2008, and you and see the measurement, so you will see that it will be wide reaching and it will take months, if not years, to identify their impact. So as we move forward, and when this M&A becomes, let's say, top of mind again, the mid market is going to be like a very the critical. So the mid market business will need to explain what their new substantial profit levels are, which will be the primary driver of valuation in which buyers transact. And when the rebound does occur, there will be a flood of opportunities brought to market for deals that were either paused or held off. So we will see that significant level of distressed M&A opportunities, which will arise later this year or following a period of unrivaled state support. A huge weight of global capital remains to be deployed if you look at that way. And the interest rate is going to remain low, which is again creating an opportunity post this crisis. Well, and the corporate which are driven by very a high leverage and lower earnings, they would need for working capital, which will need urgent funding. So this will again require understanding of local insolvency regimes and techniques, so which will again have a further opportunity in the post crisis. Then we have a trade and PE backed trade may have a significant consolidation advantage over standalone PE. So that is again another significant change. We see that. Uh, and I think it's reasonable to assume that it could be some time before mainstream M&A activity resumes. The relocation of capital is likely to move to distress investing at the initial stage. But as we move forward, it will be more into looking for the value proposition. So the business which can create value in the long term. And from the deal maker side, if we see that as they are ready to focus again on their core pursuit, you will have plenty to think about. For companies that have built a healthy balance sheet during the economic boom of the past 10 years, declining valuation will create opportunities for them to pursue deals that create long-term value. So what we see is that based on past results, we have seen that the deals which are done during weak uh, economic times create value for the deal makers and their shareholders, obviously. But what is critical also is low valuation are not only the reason that weak economy deals outperform. So one have to be cautious in that also. So uh, there are more fundamental reasons why acquisition in weak economies create value, which is like a company can take advantage of the environment to execute its strategic acquisition agenda and to position the business to exceed industry average growth, so that once the economy recovers, it accelerates out of the recession. A business will focus more on integrating the target uh, during the downturn. So that's another kind of an opportunity which will come out of this crisis, because the time when your competitors are busy trying to survive, you can focus on integrating that target, and then fully benefit from the synergies in the recovery. So overall, you see there are lots of opportunity which will come out post this crisis. However, it depends that organically how well the business are prepared, especially driven by the leadership in terms of being ready and agile to improvise the strategy and look out for the opportunities, be it in the long term or the short term benefit. So I would say opportunities lies for the people or the leader, those who are prepared post crisis. So it is not something which will come automatically to everyone. It's definitely requires a proactive planning and preparedness for it. But we see lots of opportunity, especially in the M&A domain, aligned with the strategic aspiration of the business.
Okay. So, Oliver, you want to add something?
Yeah, well, what I was going to add was, that I think that's a really good point that was just made about the difference between PE and trade and the opportunities that COVID's now going to present. I've read quite a lot at the minute that's saying that PE is going to be, the white knight sailing in and buying everything up, you know, with 1.5 trillion of dry powder sitting around, and as an asset class, it's probably going to be, you know, the leader in this. And actually, just on Shiv's points, I don't quite agree with what people are saying. I think Shiv's right that trade buyers are going to have the advantage of the value add proposition, the synergies, the integrations right now. And I think whilst P will probably increase its share of the market, of the M&A market for 2020 as compared to 2019, I think ultimately, you know, maybe that might rise to about 20%. I think it's important to remember that P actually in the region has been a net seller rather than a net buyer over the past few years. And so I think the P model, which requires a large portion of debt, less than the old LBO days, but still a large portion of debt to be added in, is now looking less likely due to the uncertainty that we've talked about before. But I do still think P will be having a good participation in this, and this is where the market's probably going to change. I think P will be acting as a debt provider as we emerge from crisis. I think they'll be taking quasi-equity or mezz debt positions, and maybe Hugo has a view on this as well. But I think that's where P are going to shift maybe from their traditional buyout model to maybe actually being a financer for the next 12 to 18 months.
I think Oliver, you've hit the nail on the head, and I share your view. I think it's particularly relevant in the Middle East, where I think P isn't necessarily going to be as significant a player as it might be in Europe and the US, partly just because the market and the depth of funds isn't as large, and a lot of those funds are actually looking beyond the region as well. The other piece to highlight here is that, you know, PE buyers buy for cash. They don't have any assets to sell, or to contribute. So the consequences for those sellers is that they're actually exiting today, and normally at pretty low, as we discussed, valuations. I think what we're seeing, and what I think, you know, will become a bit of a trend over the next few months is potentially some of the SMEs actually getting together and sort of non-cash mergers where businesses can put themselves together, realize cost synergies, potentially some revenue synergies, create a stronger, more scaled combined company, and then retain further, as Shiv said, sort of accelerated upside through the recovery. And so I think the trade angle here and the strategics role, rather than necessarily financial investors, particularly in the Middle East, is going to be strong. I mean, I think, you know, in an area I spend quite a lot of time in sort of oil field services, I think there are a lot of oil field services companies of a certain scale that's not necessarily large enough to attract the attention or to really get beyond the UAE or Saudi or the region, and actually bringing a couple of companies together, creating that strength and indeed scale, be it geographic diversification or just revenue, I think will set these companies on a much stronger footing looking forward to recovery, or indeed if this crisis drags on, makes them more robust for the next 2 or 3 years, so that you have a longer runway to a recovery as well.
Oh, great point. Great points. Shirley, maybe let's go to our third poll question and see what our participants think. What do you expect M&A activity in the Middle East to resume to pre-crisis levels? So do you think it's going to be V-shaped recovery, U-shaped recovery, W-shaped recovery, or any other shaped recovery? So what do you think it's going to come back to 2019 or pre-crisis levels, second half of 2020, first quarter of 2021, second quarter of 2021, or during or after the second half of 2021? So what do you think? Please participate and let us have your view. Are we done with 30 seconds, Shirley?
65% have voted, so we'll just wait for 10 more seconds and close it. Yeah.
Okay.
Okay.
Okay, so 41% of our participants think that Q1 2021, the pre-crisis level transactions would come back. That is really, I'm really glad to see the optimism in my participants, and being an auditor, I would extrapolate it to the general population. So this means that there is good amount of optimism in the market. So maybe we build from here, and Hugo, I will come to you. We have looked what our participants think, and we also have looked other news and surveys and reports when the deal activity is coming back to pre-crisis levels. Mm-hmm. What do you think that what companies are waiting for? What uncertainty has to go away to convince the companies and investors and market participants to come back to the market and start activity at the same confidence and with the same robustness?
It's a good question. I think perhaps participants are getting less optimistic as we go through this presentation, but I think that the key is, as we've said multiple times, is overall uncertainty. But I think the key aspects that play into that and that are figuring in a lot of minds is around the sort of lockdowns and travel restriction. And will there be, whilst we're certainly in the UAE coming out of those at the moment, is there a risk that you go back into these sorts of scenarios? Because that was what killed a lot of the demand and consumer spending in the market, and a second lockdown could be more damaging than the first. So I think that is the key concern for the rest of this year, and I think it will be interesting to see where we get to. I think there's still, and I wouldn't characterize it as the market waiting. I think people are still willing and active at looking at opportunities. I think the issue is that the spread between the buyer and the seller in terms of the valuation multiple is so wide. And so I think what we need is some consecutive months, and at the moment it's hard to put 2 weeks together, of consistent data. And so having a couple of good months, hopefully it's the next couple of months, where oil prices remain reasonably robust. Growth expectations are down this year. That's not going to change, but at least they begin to form a consensus and they don't change month to month. With that sort of base, then you can get what I hope will happen is the capital markets will reopen. One of the biggest challenges to M&A today is that, as Oliver's mentioned as well, debt availability is pretty constrained. And so with some of that stability, hopefully that will allow the banks to get, and other debt providers, maybe it's PE, maybe it's other non-traditional lenders, are able to have the confidence to provide capital for M&A, which is traditionally a little bit higher risk than capital for existing or organic needs. So I think that sort of consistent economic data has to be the key, and everything else that goes into M&A sort of flows from that.
So if I sum up your points, because this is, I think, very interesting in discussion. So if I sum up your points, Hugo, travel restrictions, consistent data for a few months, and the debt availability, these are three crucial points which has to happen before the certainty, same level of certainty, or somewhere around that comes back to the market. Is that fair?
Yeah, no, I think that's right, and I think perhaps I'll just add to finish. One aspect that's particularly challenging for local companies, public local companies. If you look at the exchanges for DFM, ADX, they've some of the worst performers of the main stock exchanges, and therefore there's limited cash. For businesses that don't have much cash on their balance sheet, there's not much debt available, and then their equity isn't worth much. So M&A can be very dilutive. I think a recovery in the DFM to some sort of level, getting back to where we started the year, will be challenging, but at least some sort of uptick in equity values will also be helpful and gives another currency for companies to use in M&A.
Okay, great. So Shirley, maybe we can go to our next poll questions, and we all talk about new normal. Nobody really knows what that means, but we all know that there would be a new normal. So thinking of new normal, whatever your standards of new normal are, what do you think, what changes you would be seeing in the way M&A is carried out? So that is our next poll question. So please participate so we can understand what you are thinking. Again, this new normal has really no standard definition, so everyone has its own definition of new normal, and all definitions are correct, of course, because one thing is for sure, we know we are not going to go back to what we were, the way businesses were done, the way transactions were happening, the way processes were controlled and managed will not be the same as we had pre-COVID-19. So that is for sure. Now, from there, you can have your own definition of new normal. That's fair. So, Shirley, are we?
We have about 60% voting. Can we wait for 10 more seconds?
Okay, let's wait for 5 seconds.
Okay.
Okay, so increased digital world, we will see more digitalization happening in this area, more virtual due diligence rooms and more virtual conferences and meetings and so on and so forth. 11% think that negotiations to take place via video conferencing, and 39% think that there is no permanent changes. So 39% of our participants are thinking that whatever this new normal is, that is going to go away. So maybe we build our discussion from here. This is very interesting result. Oliver, I will come to you, and maybe you can take from here. And what do you think? What changes do you expect would happen in M&A world, and how the transactions are done? What changes do you think would happen in that process?
Sure. I mean, I think of the polling questions that we just had, any one of the three, the first three, or multiple of those first three are all things that I would expect to see. As we look at the new normal, I expect to see changes in how we do M&A across the entire life cycle. So that's pre-signing, split between signing and completion, and actually post-completion. In terms of actually how we're getting deals done, I think the processes will largely remain the same, but how it's conducted will change, and the bulk of these changes, slightly contrary to 39% on the poll, but I think some of these changes will be for good. In the same way, we've seen a number of multinational businesses over the last few weeks announce that they're moving formally to a 100% remote working model. I think M&A is going to have to also at least be prepared and ready to be 100% functional at a remote model as well. And what's quite interesting is private equity funds and VC funds that I was speaking to just 6 months ago. You have a drink, and they thought absolutely there was no possible way that you could do a deal virtually. They thought you needed to get into the room with the management team. You couldn't know a man until you looked in his eyes. You couldn't know a management team until you'd really spoken to them. And I think they, over the last few months, have accepted that that is maybe not quite true. And I think the reason for that is despite COVID, being called social distancing, quite a lot of it's actually just been physical distancing. And the social element has still been there. There's still been a lot of calls, there's been a lot of webinars, there's been a lot of video conferencing. In a world of Teams and Zoom and all this, I think actually teams are closer together. And in fact, some of the multinational deals that are being done have always been done digitally and remotely. And so if we just take a couple of steps, I think due diligence broadly is already done via virtual data rooms. If I look at the change in the next 12 months to the due diligence process due to COVID, I think we're going to see a much deeper dive. And now that the sort of seller-friendly market has shifted to a buyer-friendly market, and certainly I think the ability or the days of doing just a red flag DD and covering off the rest of, the negotiations via a W&I policy to take care of the rest, I think in the short to medium term that's probably gone. And I think Hugo talked about that before, and I think there's going to be much more complicated structures, much more complicated and innovative, creative ways of doing deals. But the deep dive I'm talking about is broadly going to be areas that we're already looking at, but just in greater detail. So I think, again, as Shiv mentioned, we're going to be seeing more COVID-related DD related to debt covenants, stress testing, adequate capital requirements, and the same can probably be said with regard to diligence on key clients or key suppliers, in that a buyer is now going to really want to understand the health and resilience of these entities and how, if they are impacted by COVID, depending on how the virus goes, how that will affect the business operations of the target. But whilst I do think broadly the scope of work and diligence will be the same, I think there are certainly going to be new areas. Previously, before moving to the Middle East, I practiced in London, and when we had Brexit, we definitely saw a lot of bidder requests that asked management to create plans on the different Brexit scenarios, whether it was a harder Brexit or a soft Brexit. And I think, and anecdotally, we're seeing bidders already asking questions to management teams on how their business plans will be affected, depending on whether it's a V-shape, W-shape, or gradual recovery to COVID. Similarly, I think business continuity plans and HR plans are going to be much more focused. And quite often, due to data privacy issues, HR sometimes comes at the end of a DD process. But I think work from home capabilities, new breakout planning, underinvestment in these areas, or conservative views by management, still asking employees to be forced to come in, is really going to be a high red flag on M&A going forward, because it's not just now that the new buyer will have to make that investment into the work from home capabilities. It's that realistically that could lead to a genuine loss of business continuity. So I think the digitalization of DD, I'm also seeing, in infrastructure sites, renewable energy sites, I'm seeing virtual tours or using Google Maps. We're seeing drone footage being uploaded into data rooms, and we are seeing management meetings being conducted via video call. Largely signings had already died. Physical signings are no longer the glory from the old days, and the champagne no longer comes through the door at signing, and they've been virtual. But I do think that negotiations, live drafting, screen sharing is also going to be, depending on how the waves of the virus go, will really test if you can do the multiple rounds of negotiation just digitally online instead of face to face. Just very quickly, I want to talk about legal documentation, and just to touch on Hugo's point that was made earlier. I think deals are going to be much more outside of the box. They're going to be much more bespoke. We're going to see less sales for 100% of the share capital. We're going to see more minority, more majority share sales. We're going to see increased consolidation. We're going to see an increase the amount of deals where there is a 100% sale, but then being completed by club deals or consortiums. And I think ultimately that just adds documents to the deal. We're going to need shareholders agreements. We're going to need transitional services agreements. The increased DD is definitely going to lead to more hotly contested warranties, indemnities, and potentially restrictive covenants. And for, as Hugo said, some of the structures which have large earnouts, we're really going to see hotly contested negotiations on how the business should be run during that period. Because the old drafting cop-out of it'll be operated under the ordinary course of business now means nothing. There is no ordinary course of business, at least for the next 12 or 18 months. So I think anyone seriously.
Yeah. Sorry, I have to stop. We're running out of time. If you can quickly wrap up your point, please.
Yeah, sure. My last point was going to be on the plus side, at least a positive though, of how we see things change. In Europe and the US, we've seen a lot of regulation coming in to protect businesses over this next 12 to 18 months to stop foreign businesses that have state support from buying up businesses. At least I don't see that red tape probably being implemented in the Middle East as much. And I do think we'll have a little bit of a clearer pathway to get deals done where there is a need. And I think that digitalization is there to do the deals.
Great. So the answer was actually mixed of changes and no changes. So no changes in the substance, but changes in the way the process will be taking place. Great, great. So Shiv, I will come to you, and we have been talking about one of the points which Hugo mentioned in the previous discussion. One of the uncertainties which has to go away is the debt availability of financing. So if you can shed some light on what changes you see we should anticipate on the financing of the transactions, the way transactions are financed, how that could be different from the way the transactions are financed now.
I think, we have spoken at the beginning how the the conventional, the PE and the sovereign funds are going to play a role. So they are definitely going to look for the long-term value proposition. But I think Oliver has touched a very important point, which is actually linked with that, what type of transaction is going to happen. So it's not going to be like a kind of the 100% acquisition. So what it takes is there will be a lots of tailor-made transaction, and the tailor-made transaction can be even the no cash transaction. So we spoke earlier, where there won't be any the cash involved, and then how the different loan to own transaction. So you will see lots of innovative way of funding that transaction. And again, with regard to the buying out the stake, whether they are looking those who are having a minority shareholding, they will look for the getting the majority stakeholder. So but how to get those funding, and that is where if you see that the primary market is not going to be a healthy source of funding. So that's maybe another one, and especially for the Middle East market, it's not going to be there. So on the contrary, the business are planning to delist there. So then it is all about the unconventional funding which will come. And again, the point what Oliver mentioned is going to be the tailor-made solutions. So you will have the fund houses or the buyers looking at the different I would say the value proposition for them before they make any transaction. So again, it depends on how they prepared they are for their strategic plan in terms of whether they are looking for like acquisition, whether it's a customer and the cost synergy, whether they are looking for the supply chain acquisition in terms of the vertical integration, or they are looking for the complete new plan or the new platform or the new service. So what happens is, depending on the what proposition you are looking at, you will have a different the fund providers with the different objectives. So you might have some funding which are because even when we talk about that Greek economy, you have everything interest rate, everything is low. But if you look at from the investors required rate of return, their premium goes up. So they need more return if they want to invest in this tough market. So I would say it is going to be again depending on the what the proposition, be it a buyer side or the seller side, what proposition they have got for the investor. and how they are evaluating it in terms of the proposition for them. So it's like when the buyer decides to buy or the seller decides to sell, what actually they are looking at, whether they are looking at for the strategic investment, whether they are looking for the investment just to sustain, whether they are looking for an investment for just working capital management for the short term. So it depends on the nature of the business investment requirement, and based on that, the funding will be like, or the investor will be looking at their risk appetite and provide that the funding. But definitely, what is the most critical here in this uncertain environment is nothing is fixed. It's everything is like the flexible. It is there is no buyer or seller market. It is a the market which has its own opportunity, but at the same time the people are evaluating it in terms of their value proposition for the short to long term. So it's not like the transaction is going to get over the moment. I think we mentioned about the meeting the deadline. So there is no such deadline. It will take lots of collaborative discussion, and the conventional earning multiples has gone. So it is not something like okay, these multiples will be utilized. So I think every business, even in the same sector, will be evaluated independently about what they have got to offer. So there won't be a like a kind of clear the plain vanilla multiple approach. So I think it's going to be more the critical in terms of the agility about the transaction, what it has got to offer. So what I feel in in overall, the funding is going to be because you have that we are going to have lots of fund which are available to be invested, but that doesn't mean it is going to come as an easy funding. So you have to really give a real value for it.
Right. So the key words what I get from you is one, unconventional financing. Second, think out of the box in these fluid environments.
Yes.
Because the situation is fluid, so you have to be flexible. Thanks, Shiv. Let's go to our guys. I'm sorry we are a little bit late, but bear with us for the next like 5 or so minutes. Let's go to our last 4 questions. Shirley, if you can bring the last question. So what sectors do you expect to be the most active in next 12 months in GCC? Healthcare, healthcare spelling is wrong, but that's fine. Healthcare, e-commerce, energy, retail, or agri-tech. What do you think would be the hard favorite sectors here? Yeah. Can we close now?
So we have 60% votes. Yeah, we'll close then.
Okay. So our participants think that healthcare would be the hard favorite sector. E-commerce platforms on number 2. Energy, retail sector. I'm a little bit surprised to see energy and retail sector at the same level, and no one voted for agri-tech. So let's go back to our participants. Now we really have gone over time. So I will assign 1 minute time slot to each of you. Please be very strict to that. So what do you think, Oliver, what do you think would be the hard favorite sectors here? Do you agree with our participants or have a different view?
Well, just to stir it up a little bit, I'm going to pick the one that got 0 votes. I'm going to say agri-tech, I think, is going to be a really interesting and hot topic. I think just last week we saw the UAE cabinet approved a sustainability and agriculture system, which is the UAE's drive, in the region to have more self-sufficiency and more competitiveness of local food production. And I really think we're therefore going to see a synergy amongst multiple sectors, construction, agriculture and technology, into things like vertical farming, more genetically modified foods, things like that, that really, really drive home these long-term deliverability targets that are key towards government long-term infrastructure and sustainability plans. That's my 1 minute.
Wow, very interesting, very interesting. Hugo, what do you think?
So I'm going to be controversial as well and go for something that wasn't an option, which is the sort of banking sector. Look, I think particularly for smaller businesses, with less established franchises, and if this is an extended downturn in particular, I think they're going to need to get together. We've already seen a bit of a track record of banks getting together in the region. I think what will be interesting is if there are any more cross-border transactions in the coming few months. I'm not sure there's necessarily going to be a wave today, but as this drags on, you may find banks getting together to shore themselves up and become more resilient.
Great. Shiv.
I also will go with Oliver option in terms of the agri-tech sector. But like if you look at in combination with the e-commerce platform and like agri-tech, basically what we are talking about the production and then the certain technology related to in the supply chain. And if you link it with the e-commerce platform to provide the better pricing for that product. So I see that combination, especially the countries which are like the agriculture-driven economy, and those sectors, it is going to create a lot of opportunity. And I think what Oliver mentioned, even especially in UAE, is this is something is going to play a key role in terms of having a value proposition for the investor. Yes, it requires those business to be aligned with very like I would say digitally robust, improvise and agile supply chain process is something is very critical to offer that value for the investor, especially in the combination of those two segments.
Interesting, really interesting. Anyways, thank you so much, folks, for providing your views, and especially thank you very much, participants, for logging in and listening to us. I hope that this session brought some value to you, and this session you might have some takeaways with you, which you can go and apply those or explore further to be applied in real life. We are here, we are around the corner. Bracewell, ourselves, Evercore, if you need any help, give us a shout, and we will be really happy to help you in your acquisition or disposal aspirations. Special thanks to Shirley and Ramesh, which you cannot see here, but have been a big support in putting all this together. So thank you very much, everyone. Have a great day.
Thank you.
Thanks all.
Thank you.
Thank you.
Bye-bye.